Todd Gordon, Inside Edge Capital. Todd, are you in a new environment?
Yeah, I moved the office. It's a write-off. How about that?
Yeah. That's beautiful. I love it, Todd.
Thanks, man.
Todd,
Thanks.
This market relentlessly to the upside. You've been bullish for a while correctly here, Todd. Let's just start with, we're 5,000, S&P 5,000. Can we go to 6?
Deal. It's
Can
a
we go
big
to
deal.
6?
And bid.
And bed.
Yeah. I mean, where do you want me to start? It's an unbelievable move. I think we have clarity on sort of the macro front. I think, the last 2 years have been very, Fed and rate policy driven. I think the focus is a little bit more on consumer. And, I think, this tech innovation we're in is real. I hate to be a rah table pounding bull because I'm not like you guys. I'm a trader just like you guys running money. Like I can close everything in an hour and be short, but I don't think that's the play here.
No, it doesn't feel like the play. And people have been trying to call the tops in all these AI stocks relentlessly here. NVIDIA, I heard it back when it was 500. Well, that's it. It's going back to 100. Then it was 600. Then it's going back to 500. Now it's 700, but it's going back to 600. I sense a pattern forming here. And I am long NVIDIA, and I'm like, usually I'm not participating in all these, like people. But I've said before, the valuations is not insane here. So NVIDIA, SMCI has just been rocket ship mode. AI stocks are just gone fire. I mean, ARM isn't even really an AI company, but it's got a piece of AI, and then they just grab it and run with it. This AI, is this a bubble or is this real?
I mean, okay. So let me ask you this. When did the uptrend start? According to you and Joel, like when did we officially go into bull market?
In this AI?
Let's call it the NASDAQ. Like when did we?
The NASDAQ was 2023, early 2023. Whole you're 14 months into the bull market. I would say 2023 was the calendar turn in 2023. Now the IWM and the other stocks really just started picking up in October of 2020.
Right.
So you have the tale of two markets, and they really haven't even picked up that much. I mean, it's been the tale of two markets. And tech, which has just been killing it, and then everything else has just kind of been like not that great.
So I mean, like I would take the other side and say it's hard to say a bull market started 14 months ago when like I was on Twitter like vehemently defending being bullish. It's hard to say when so many were convinced we're going into recession and sell all stocks that in fact the bull market was starting. I mean, maybe you look at it, and this is a stupid argument because nobody knows the answer. It's very subjective, but maybe it's when we just broke out. So maybe this thing is 2-3 weeks old. So, if you look at, how do I share screen? I mean, do you guys mind if I
you can
go down, present.
Okay.
I mean, I just like to be just simple, with the NASDAQ, right? I don't want to get super crazy, but, I mean, just look at the advances that we've seen post tech crash. Here's the GFC, here's recovery in the GFC. And I mean, you don't need to overcomplicate it. Like the first move off of the 2002 low up into the housing was 182%. The next one was 100%. Right now, what are we at? Probably 60% right now, maybe from the lows, which again, many were telling us that we're going into recession or depression. And, we're only up 68% from there. So I think there's a lot of good things going. I mean, I think, the valuations that, everyone's struggling with, traditional valuations are being challenged with the fact that we have, 4-decade high inflation, rates are higher, real cost of capital is a little higher, real rates are higher. We have incredible efficiency happening in these companies, and the technologies they're putting out are going to be widespread, applicable across so many different industries. I think it's really premature to say this thing is long in the tooth and even say bubble, Dennis. That's just my humble opinion.
And again, people want to keep comparing. I see it on Twitter all the time. This is just like the 1999-2000 tech bubble. But the big difference was, I can remember Microsoft, it was trading 85 times earnings, Todd. We're at 32 times.
You said it earlier, and I'm sorry to interrupt. I almost interrupted you last time. I'm interrupting you now. Okay. What's Ford valuation on NVIDIA right now?
35 times.
35. And what's Eli Lilly forward?
Oh, crazy. Lilly will be
It's like
more,
50
yeah.
or 60 maybe.
Yeah, it'll be 60 probably. I haven't looked at it for a while, but again, and those projections are hard to do on Lilly because we just don't know how
Right.
many people are going to actually go out and buy this drug. So Lilly's a little harder to project. So maybe
Right.
it's going to be way more. Maybe that's what the market's saying. It's going to be way more. Forward P, Benzinga Pro's got it 58 right now on Lilly.
Whew.
So I
58
mean,
times ordering. Okay.
it's not
Okay.
cheap, but again, that's a hard one to project. Nvidia is a little bit easier. But again, projections, and people will argue with me, Todd, bro, forward projections, you can't look at those. You have to look at trailing because forward projections, those are just, the companies are guessing. Well,
Right.
companies usually pretty much know their
But
business pretty well. They
But
often hit these forward
but
projections.
that's what the market's trading on here, Dennis. Would you agree with that? It's not so much what the current EPS revenues are, margins, et cetera. It's all about the guidance. It's all about guidance. And forever, for the last 2 years, we were all, in my opinion, CEOs going out there and under promise, then over deliver. Set the bar super low, beat it, just do it again. And I think that jig is kind of up, so to speak. I mean, now I think it's all about, I think they have to have good, strong guidance going forward. And analysts are now, the markets are trading based on analyst expectation, what the CEO's putting on guidance. So I think that's starting to improve. We have, on the rate front, like maybe we can stop all being macro, global macro traders and fawning all over the yield curve, which was the key driver of growth value rotation over the last 2 years. Rates are finally going quiet. Thank goodness. Like we can just get a 10-year at 4.25, 4.5, stay in a range. Like, okay, good. I think that'd be an ideal scenario. And I think we can live with 4.5% 10-year yields. The real yield is what, 1.5%. I saw that inflation revision just came out. We're still running 3.3. So I think we're in a really good place right now. I like where the market's at. I think there's a lot of bearish sentiment out there, still underparticipated. I don't know what the short figures are, but I feel like there's more money coming in. And trust me, I am not a long only. I love trading like you 20, 25, 30 VIX markets. Like those are super fun.
Fun.
But I don't see it here.
Where do you think we can go? We're 5,000 here on the S&P. Again, it's hard. You're a trader, so given making price targets here, you're not an analyst here. I'm not going to throw you under the bus and say, "Give me your 12-month price target here."
No.
But where can we, like? Is there any? Can you use your technical analysis skills here and give us any type of projections on where this S&P might be going?
I didn't even bring up my my technicals just for this, for a reason. And I can bring it up in a sec. It's so simple right now. It's scary. I'm an Elliott Wave guy, for better, for worse. Like, I'm thinking about just going in the closet, not talking about it, just do it. And I'm sick of defending it because there's so many people giving bad. But if you look at Microsoft, you look at S&P, you look at the NASDAQ, you look at even bookings. I was just listening to you on bookings, BKNG. There's so many simple 5-wave moves up from either the late 22 or the early 23 low. I'm literally up at night thinking about how are we going to escape this? And it's such a simple, obvious 5-wave move, which was given to us by Charles Dow. He's the grandfather of technical analysis. Markets move in 3 primary advances, accumulation, widespread participation, then distribution. This is going back to Charles Dow. So the model says we're in the distribution phase off of that 23 rally. I'm really curious to see how the market handles this. Guys, I've been saying this for like every morning video that I do for clients and investors. Like, I can't remember a time I've been so short-term bullish, but beyond short-term, medium to longer-term concerned for a 10 to 15% drop. And I'm not going to sit by and give these profits back. Like, I'm going to go to work hedging, but I just don't want to take it off, because if the most obvious pattern, which I just described, is wrong, this thing's going to freaking ramp.
I want to talk about rotation here too.
Sure.
Because, and it was asked in the chat, and the people waiting for this IWM. You and I have had great discussions on this on the At the Close show, and you kind of took the attitude of like, well, does it have to go? Do these companies
why? Listen, I've only been doing this for 20 years. Would somebody please tell me why a 4-decade high environment in terms of interest rates requires fundamentally unsound leverage companies who don't have access to funding? Why do they need to participate? 800 of the 2000s, Russell's 2000s are not profitable companies and they have questionable balance. Tell me why this index needs to participate. I really would like to know.
I mean, you look at Children's Place here today, case in point here. I mean, smaller company here. There obviously interest rates have probably been an issue here for this company for a while. It's down 55% this morning. I mean, how many other companies are, the banks, IWM is very heavily the banks. They've had some problems with it too.
Yeah.
So, I mean, I think you're right. I mean, why there's a reason why these companies, and the IWM just hasn't participated, and that is rates.
Right. But there's two stories to the small cap. Take a look at the S&P 600 small cap. They put a fundamental filter on there. Much different story. Look at the CALF, the CAF ETF, the top 100 free cash flow small cap companies at highs. So I'm not buying it.
We've seen this before. We've seen this before.
I love the rotation. There's a lot going on here, and I'll just kind of break this. This is great. Julius de Kempenaar came up with a great way to visualize rotation. What I'm doing is taking the best performing industries within technology. They are obviously going to be semis in green, semi material and equipment, tech hardware, which SMCI and Apple actually go in there, system software, application software, and tech distributors. So what I'm doing is I'm going to start the rotation. This is November of 23. Here's the turn of the year. What you'll see, obviously, no surprise, semis are going to rip up and to the right. No surprise. Huge move in semis. Now, this rotation is happening on a clockwise basis, and the benchmark is the S&P 500. So as you're moving up top of the right, semis are outperforming, no surprise. Semi materials and equipment are there. But the problem is the breadth, even within tech, is getting a lot less. We're losing system software, application software. Forget about hardware. I mean, Apple is, where Apple is. I don't mind.
Yeah, it hasn't done much.
But the software stocks, which were so strong back here at the end of 23, here was the rotation. I know it's hard to see. You got to kind of get used to it, but see the movement in system software, application software like Cadence, Synopsys, Manhattan, ServiceNow, like CRM, Adobe. Those things were ripping. But now they're taking a pretty good back seat, and I'm a little concerned because breadth, even though we're getting healthcare and there's different names moving up to new highs, breadth is deteriorating, and it's increasingly the weight's going on the shoulder of semis. And that's another reason, thinking back to my simple 5-wave move off the 23 lows, like is healthcare going to lead it? I don't think so. So that's my question that I'm really contemplating.
So what makes you, and obviously you're holding, you said you don't want to sell, you're holding. What's the sell signal? What are we looking for that would say, hey, we just topped out, let's get to cash? What is that signal? The magic signal.
I mean, I'm watching bonds, 30-year bonds were just bid on that number and they just gave it all back.
Yeah.
Right? So, what's the sell signal? I think there's still too much bearishness out there. I don't think these kind of bull markets, die from boredom. I think we need some exuberance, but it all depends on the time frame, right? I mean, if you're talking at 10 to 50% pullback that I'm talking about, if we don't get follow through, if the bearishness persists, we are coming into a seasonally weak period. We might, the lack of participation on the upside, we might just have to take some profits here. I don't know. I don't know the answer to that.
Don't we need some consolidation first? I mean, at least see some consolidation right now. I mean, you're doing your levels. Support keeps moving up. You're making higher lows. You're making higher lows. You're making higher highs. You're having higher closes. At least, I mean, until you try and call turdiness, at least you got to see some kind of consolidation before that, and not seeing that today.
That's a good point, Joel. And here's a study I'm looking at: percent distance from the moving averages. So let me go to the weekly.
I was asked about that yesterday. Yeah.
Okay. What were you asked?
I mean, do we have to go, like NVIDIA is so far away from its moving averages? Don't we have to go back there? And my response is, we don't have to do anything.
We don't have to do anything. Yeah. So let's look at that. So this is a kind of squished in weekly chart. I want to look at the weekly NASDAQ. So the 50 week is the dotted gray and the 200 is right there. So distance from the 200 week currently is 31%. And I would say on first blush, if I just looked at this, the optics of price from the 200 week, I would say, yeah, it's pretty stretched. We probably need to come back. But then when you put it on this chart and you actually quantify it, we're only 31% above the 200 week. And there's plenty of precedence to be 60, nice. 70%.
Wow.
We seem to, from 2012, 14, 15, 18, 19, when they first started to hike rates a touch, we were hanging at 40 to 50% above the 200 week. So I think longer term, Joel, it's a really good point you make. We're way from overbought on the 200 week. The 50 week near term, to your point on consolidation, I think, I'm listening to myself, I'm monitoring myself. I'm like, oh, huge move higher or lower. All right, calm down. Right. So maybe it is consolidation, because if you look at the 50 week kind of hidden in gray, distance from price to the 50 week, you look over the right scale, about 28%, 18, 20%, so we're there, we're at 17, but we're not, 2020, we're not at 30, 25%. So maybe it is consolidation. If you think about it, if we go sideways for a while, because big earnings are mostly out of the way and we don't have a Fed meeting until May, and we won't even get any March. I'm already thinking March is a no, nothing's going to happen. Maybe price consolidates, giving the 50 week moving average time to catch up as price goes sideways, sort of backing that off. And maybe that's the consolidation we need. I'm so long NVIDIA. I got stock up the wazoo. I got options. Expiring today. I've got call spreads up top.
That's a nice place to be, but it makes you nervous when this thing just goes parabolic, and then you're like, oh, should I ring the register on some? Right. Should I just keep holding? What's the sell signal in NVIDIA? When do you get out of that?
Well, I've got technical levels at 740, and I've been that way for a while. I have a lot of my net worth in NVIDIA, a lot more than it should be. But I'm in from a very good price, so it's a ton of cushion. So it's we increased holdings in the wealth management NVIDIA. So maybe the greatest pain trade, guys, is maybe just sideways. As I'm watching NVIDIA screw around the 700 level, I mean, I'm having flashbacks in NVIDIA from 500, right? I mean, how long?
Yeah, I am too. It did not pause at 600. 500. Look, if you go to the monthly. Yeah, look how many times it 500, 500, 500, 500. And then it wasn't until the fifth attempt. Now, 600, if you took that philosophy at 600, you got absolutely rolled over. 700, I mean, it's hard to say that it's going to be the 500, at least at this point. The other thing I want to add is that with the data that we got today, do we have to worry about the CPI and PPI next week? Right? Guys, we got that data coming out. So there's a lot of things here. Todd, we're coming up against the clock. Todd Gordon, Inside Edge Capital, joining us.
He had one more point.
I got so much more to say to you guys. Two things. I know I'll get off, I promise. What happens if 24, if the phrase goes from how much is the Fed going to cut this year is, well, thankfully they're not going to raise. Maybe, right? And then the other thing I'll put in front of you, I want to put in front, consumer discretionary is lagging. I get it. But look at the numbers from Amazon, specifically Prime, adding subscribers, advertising numbers strong. Look at Spotify, adding huge numbers. People are advertising. And then the other one I had to note, oh my God, it was Amazon, it was Spotify and Netflix. The growth there on their ad tiers, ads are big right now. And I think companies wouldn't be investing in advertising if the consumer was truly on unstable footing. So maybe I don't think we're going to get as many rate cuts as they think this year. That's going to be the realization process market's going to have to go through. All right. Thanks
do we need to do it? Todd Gordon, Inside Edge Capital, joining us here on Pre-Market Prep.